Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter for business and the people that own them. This is Eric. Welcome to this episode of Wait, What? Financial matters that matter for businesses and the people that own them. I have returning guest with me today, Shawn Bragdon, Managing Director from BGA Insurance here in Costa Mesa, California. How you doing, Shawn?
Great. Thanks for having me.
Today's topic, we're going to talk about long-term care and also disability and draw contrast between the two. And I was hoping you could help me do that, Shawn. You've done a lot of different things for me. We've done more long-term care than any disability, but I want to kind of draw contrast and help the listeners understand which each one of them is and also how they differ.
Well, let's start with disability income. One thing, why do you buy it? Well, it's if you get sick or hurt, it's typically going to pay up to 60% of your annual income tax-free. If you're, supporting your family, your income is certainly very important. You should certainly have some disability income insurance. A lot of companies offer, both short-term and long-term disability income policies in their group plans, but then there's better policies available in the marketplace. What a lot of people don't realize, though, is a disability income policy disappears after you turn 65. So I think the best candidates for people for a disability income policy would be people that have at least 10 years or more before they retire, or 10 years before 65. So let's say 55 and younger.
But if you're still with the company, you still have the disability insurance if you're over 65, right?
No, the policy just falls off.
Oh, wow.
Yeah, there's no more coverage.
Okay.
And again, the maximum you're going to get is typically going to be 60% of your income. And the price of disability income policy is typically going to range 1 to 3% of your income, and the actual premium will vary depending on your occupation, your age, your underwriting, that kind of thing.
Well, a lot of business owners are asking me about long-term care insurance. They've had parents who are in long-term care facilities right now having to dwindle down the assets of their parent to pay for it, and it's something that they really want. And I'm under the impression there's no standalone policies anymore, but they're part of life insurance policies.
Yes and no. There are still a few carriers that offer a standalone long-term care policy. In the state of California, I think there's 2 carriers that still offer that product. And to tell you the truth, we are not selling any of it. It's a shame because people don't realize the odds of needing long-term care are actually 70%. It's kind of interesting that, the odds of having a car accident are less than 1%, yet everyone has auto insurance. You have to have auto insurance. The odds of having your house burned down is less than 1%, yet everyone has fire insurance. But the odds of needing long-term care are 70%, and there's a large group of the population that does not have long-term care insurance. And I think one of the reasons, people haven't purchased long-term care as much as I think they should is one-off. They think, hey, it's not going to happen to me. And they're thinking it more as an expense rather than a protection of their assets. And, if I don't use it, I wasted all that money, which brings on the invent of what I call a hybrid long-term care policy. That is what we're selling today. And those are far and away the product of choice if you're looking for long-term care protection.
What do you mean a hybrid long-term care policy?
Well, a hybrid long-term care policy is actually a life insurance policy with a long-term care rider or benefit. So there is a death benefit and a long-term care benefit. And so one way or another, it's going to pay off. And that's far and away the most commonly sold product. And they are very cost effective. And, you have the gamut where people are paying an annual premium every year for that type of product. Some products, might just do a single pay and be done with it. Some people are doing a 10 pay. That's also very common. So that's far and away the most common product that we're selling.
So if I understand you right, it's a long-term care policy, but also a death benefit. So if you don't have a long-term care situation, you just pass away, the death benefit will be passed on to your beneficiaries.
Exactly. So you might have a $300,000 policy, a hybrid long-term care policy. You have $300,000 of death benefit and or $300,000 of long-term care protection. So if you needed long-term care, that death benefit is typically paid out on a monthly basis. So it might pay out $6,000 a month until you've exhausted that $300,000. But, maybe you have a long-term care event, you get better, you've used $150,000 of your $300,000 death benefit. The remaining $150,000 would be a tax-free death benefit paid to your heirs.
Oh, that'd be great. So should you back into the death benefit based on your long-term care need? I mean, it depends on what facility you're in. I mean, $3,000, $6,000.
Well,
I hear some are as much as $20,000.
Great question, Eric. The cost of long-term care is actually increasing pretty rapidly. I saw some study that over the last 5 years, it's increased by 27%. And you can actually do a Google search and type in the cost of long-term care. And there's a lot of free calculators that you can actually plug in the city that you live in, and it'll tell you what the costs for the various long-term care services are. In Southern California, where we are here today, if you had a long-term care event, a typical long-term care event is going to last 3 to 5 years. You either get better or you die. And, there's not a lot of in between. And it's going to cost somewhere between $180,000 to $225,000 today in Southern California. In 20 years, it's going to be an estimated cost of $400,000 to $600,000. Other places, it's going to be cheaper.
So when you say today, I'm just thinking if you're a young business owner, 45 years old, 40 years old, you need to look out in terms of the inflation costs and what long-term care might be. So getting a policy today to cover, $6,000 of long-term care may not be sufficient when you actually need it.
It might not, but you don't necessarily have to buy a policy that covers 100% of the projected cost. Getting something is a lot better than nothing. And these policies are not that expensive. I mean, here's an example. If you were a 65-year-old woman, you could get a $300,000 hybrid policy. It costs you about $5,200 a year. If you decided to do a 10 pay on that, 10 premium payments and you're done, it'd be about $8,300 a year. I think the key is to buy the policy before you need it.
Right.
You have to go through underwriting. By contrast, a 45-year-old woman, 20 years younger, that same hybrid policy would cost you about $1,700 a year, so less than half the cost. Or you could do a 10-pay option. It'd be about $3,000 a year. And that way you have at least $300,000.
So when you say 10 pay, make 10 payments and you're done.
And you're done.
Okay. Wow. So you were quoting women, and I know you and I talked about this offline. Women, the cost of long-term care is greater for women than it is for men.
Yes, they file claims more frequently than men. Often men just die. Mm-hmm. Unfortunately for us. Yeah, women live longer, they file more claims. And so actually, a lot of times on a traditional long-term care policy, the cost would be more expensive for a woman. With these hybrid policies, the costs are very similar to a man.
With the hybrid policy, isn't life insurance in general cheaper for women than it is for men at the same age?
It is.
Okay, but still health comes in as a factor.
Yes.
And it's also underwriting. Got to be underwritten.
Yeah, and you'd be surprised we're selling a lot of policies to people in their 70s for a hybrid long-term care policy. So you just don't have to assume that someone in their 70s can't qualify for that type of policy. They can.
Is there an age maximum?
Yeah, typically, there's a lot of different products out there, but you're probably going to max out, I think at age 79 is about the oldest age you can get some kind of hybrid policy.
Okay.
And there's another product that's fairly common out there. You bump into a client, he or she might have $100,000 sitting there at a bank, earning 20 basis points or 1% interest taxable. It's just their safe money. They're not, doing anything with the money. You can leverage that asset. There are products out there where you could dump in that $100,000. You have, $500,000 of long-term care if you need it. You have a $200,000 death benefit. And if you decide you need the money, it's there. These products are liquid. So that's another option.
So I look at it, and so again, contrasting disability and long-term care, it seems like you need them both. You'll pick up the disability at your job, but that's only going to cover 60% of your income until you're 65.
Yep.
But the long-term care, you could have that in place for that long-term care event and have your disability income coming in to sustain your lifestyle, but have the long-term care for the facility or in-home care.
Yeah, the long-term care will last forever, but certainly I would recommend both policies. I mean, as I mentioned earlier, everyone has fire insurance, everyone has health insurance, everyone has auto insurance, yet the odds of you needing that insurance are actually a lot less than needing disability income or a long-term care policy or long-term care event. The other thing is, one of our insurance carriers that have had a long-term care policy for over a decade, I asked them, what was the oldest age that they've had a claim over the last 10, 11 years? And the age was 52.
Wow.
That was the oldest age. And it was a car accident, That was the oldest age that they've actually filed a claim for. So I've talked to some financial advisors that, hey, you're only 45 years old, you don't need long-term care insurance yet. We can talk about that later. I mean, I think that's just a huge, huge mistake. You're always healthy till one day you're not, right?
When you said the average age, I thought you were going to say like 65, 70.
No, that was the shocking. Oldest claim was age 52.
Wow.
And so, again, I think the perception out there for a lot of people is that long-term care is expensive and I won't need it. And I think the truth is the exact opposite. These products have morphed over the years, especially these hybrid products, and they're very cost effective. They're very reasonably priced. And the odds of needing it are very high. Nowadays, we're actually having adult children that are concerned about them having to deal with taking care of their parents, and they're buying policies on their parent to cover that expected event.
I have that same exact situation going on right now for one of my clients. The unfortunate thing is her mother would not qualify because they're spending down her assets to cover the long-term care needs right now.
Yeah, I mean, that's, another potential myth that people can qualify for, long-term care needs using Medicaid or Medicare. I believe Medicaid will only pay for, 100 days of protection. And then for Medicare, the only way you can access those benefits, you pretty much need to be broke. No income, no assets. That's the only way you can qualify. And so for, most people that expect to have those assets, we're even, selling these policies to people that can easily afford a long-term care event, but it's smart money. Why use dollar for dollar to pay for a long-term care event when for pennies on the dollar you can have that protection? And if you don't need it, your family gets a tax-free death benefit.
Yeah, when you said $8,300, I think it was a year for a woman 65 and 3,000.
Actually, $5,200. No, $8,300 for a 10-pay. Yeah.
Yeah, that's right. On a 10-pay, just paying 10 payments.
Yeah.
Wow.
So in essence, 10 payments and you're done, and that provides $300,000 of death benefit and or long-term care protection. And if you don't use the long-term care, the equivalent internal rate of return or pre-tax equivalent rate of return on that $300,000 death benefit at life expectancy is actually just over 10%. That's a pretty good internal rate of return on an asset class.
Now, the 45-year-old, you said it was $3,500 or $3,100 on a 10-pay?
So a 45-year-old woman could have a 10-pay premium of $3,032 a year, and you're done. And that's for $300,000 of death benefit and long-term care protection.
And guys will be a little bit cheaper than that at the same age, at comparable age and comparable health.
Men actually, due to the fact that men don't live as long actually on the hybrid policy because there is a death benefit, they'll be actually a little bit more expensive on that type of product.
Okay. Oh, because the death benefit's associated with
it.
Okay. Anything else, Shawn, you think we should talk about in terms of long-term care or disability and contrasting the two or having both?
I certainly think having both. The industry has been very dynamic in this space over the last 10 years. To tell you the truth, the original long-term care policies, standalone long-term care policies, were mispriced by all the insurance companies when they first rolled these products out. And what you have is people that bought policies 10, 15, 20 years ago, they kept on getting increases in those long-term care premiums over the years. Now, I think the industry has figured out the pricing. And of course, the hybrid pricing is completely different. If you have a standalone long-term care policy, all those people that own that policy are very motivated to file a claim because if they don't file a claim, they've just wasted all those premiums. No one's ever going to get a benefit. With a hybrid policy, you have a death benefit and long-term care protection. So you might have a long-term care event. Maybe it's not a big issue. You can easily afford it. You're not even filing a claim for long-term care. You just, hey, I want that death benefit for my grandkids or something like that. So the claims experience on these hybrid policies are vastly different. And I think they've been priced correctly. So you're not going to get any increases in price. And many of these products, everything is guaranteed. You play that premium, done. It's guaranteed, no moving parts.
I was going to ask you, I approached you a while back and I talked about putting a long-term care rider on a cash accumulation policy.
Mm-hmm.
And I'm glad you talked me out of that and had me actually do the hybrid policy and the cash accumulation separate. And that made sense. Can you talk more about that?
Sure. So there's a lot of combination insurance plans or insurance portfolios that I see people buying, where you might have a life insurance policy that is designed for supplement retirement. By the way, it does have a death benefit, but the primary goal is tax-free retirement income. You can add a long-term care rider to that type of policy, but in my opinion, you're going to be better off buying a second policy, maybe a $300,000 policy that is purely designed for that death benefit and that long-term care protection. Because when you pull money out of a policy for retirement purposes, that's reducing the death benefit, and that would be reducing that long-term care protection. So just have a separate policy for that and have the other policy designed for retirement.
Because if you're pulling out money for long-term care, it kind of reduce the cash flow of your income, your tax-free income.
It would.
Yeah.
It would. So
and a death benefit.
I would suggest a combination plan. By both.
No, I'm glad you suggested that for that client. It worked out real well. That's all I got, Shawn, unless you have something else you want to talk about.
I would just suggest people look into it, go through the underwriting process, get a policy. Like the premiums that we mentioned, these products are linear. So if you want twice as much, double the premium. If you want half as much, cut it in half.
So just to recap, it's good to have disability and long-term care. A separate hybrid policy would be better than having a rider on a cash accumulation policy if you're doing something for retirement.
Mm-hmm.
But if you just had a death benefit, if you're looking for death benefit and having a long-term care rider on there, that could be okay.
Yeah.
If you're just looking for death benefit.
Yeah, and one other point I wanted to throw in there, a lot of these companies have, a great, you call it a long-term care concierge department. And that's one of the advantages of having this type of policy. You're with your sister and you say, Mom just had a stroke. What are we going to do? Literally days from that conversation, there'll be a person, an expert in this space, sitting in your kitchen telling you, hey, this is the facility I'm recommending you would put your mother in, and this is why. All those costs will be paid directly from your policy to that care provider. And so having those additional concierge benefits with a policy can be very important. And that's, often a very stressful time for a family. So having that backstop is certainly helpful.
Okay. Well, thanks, Shawn. Thanks for being with us today.
All right. Thank you.